Jim, we have the Dow down, 16% from its highs. 20% we go to bear market territory. What do you do if that happens? How do you protect?
Well, look, I have been using from the beginning a 2008 playbook, not because I think that it's 2008 here, we're clearly better off, but because people perceive Europe as being 2008. The lead story in the New York Times today, it's 2008. So if everybody feels something, then I have to fall back on what worked then. And people seem to forget that some things did work. Mm-hmm. Procter & Gamble reaches a level, or Johnson & Johnson reaches a level where it can yield 3, 4, 5%. The Federal Reserve has told you it's going to keep rates low for a long time. And I like income. I like the power of compounded income. I think people should look at a Con Ed and see how much money was made by just reinvesting the dividends. So, look, the protection here is dividend, and I know some people say, well, Jim, but 4%, how does that offset a 20% decline? And I would come back and say, no, wait a second. If you look at the stocks that I'm telling you that have good yield, International Paper, Kinder Morgan Energy Partners, or Verizon, they're not falling 20%. Mm-hmm. They're not. And if they do, you can buy them on the way down with higher and higher percent yield. Yield has overlooked. Dividends, people don't care. And look, a lot of the companies don't help by doing these giant buybacks, which have been really foolish. So, look, a touchstone that worked in 2008, I'm not going to sit there and have people tell me, well, geez, I don't know if it'll work, because 2008 was the worst we're ever going to see in our lifetime, I believe. And if you don't use that playbook, I don't know what you're going to use.
So then how do you take advantage of a day where we do have a 400-point rally?
This is when you look, I think the financials are just terrible. They don't have a good yield protection. There's a crisis of confidence. They have no growth. You sell those. Mm-hmm. Tech doesn't really get strong until September seasonally. I always respect the calendar. It's kept me out of trouble for a long time. You let go some tech that is having a nice run, unless the tech is so close to its cash like Cisco was, or it has a good yield like Intel. But tech and financials, companies that need government spending, the Cisco quarter was a very good quarter, except for the public sector spend, which was just atrocious. So, I think you use these days to lighten up on those groups that are wrong and circle back into a Hershey if it goes down a lot, or circle back into a Pepsi at 58, 57, a General Mills at 3.5% yield. Because these work, and we're not out of, I don't know, you go up for a day and people forget that the proximate causes are Europe and a possible recession. And they didn't disappear because the Dow rallies 300 points.
Right, all right, so you're going to lighten up on those rally days and then go into dividends.
Yeah, and it's not risk on, risk off. That is meaningless. Frankly, a Deere is a better buy than Bank of America.
Mm-hmm. All right, thanks, Jim.